Keith, give us some of the key takeaways from the earnings call.
Well, the first key takeaway from the earnings call is that Elon Musk was not on it for the first time. So that takes some of the drama away. But you know what they stressed, the executives who were on the call, was that they're still on track for their 50% annual growth. They had a very large profit beat, both on a adjusted earnings per share basis and even more interestingly on a gross margin basis, where the automotive gross margin was over 28%, even when you exclude the EV credits that they sell. That's a big beat over the 26% that analysts had been expecting. Investors, though, seem to be reacting to the small miss on revenue, 13.8 instead of 13.9, and the stock's down about 1%. There were very high expectations going into this earnings, and so if they didn't beat on everything, it looks like investors weren't going to give them credit. But the one thing to remember is, though the stock has dipped a bit in aftermarket trading today, it is up 55% since its low back in April.
We spoke to Gene Munster, who covers Tesla at Loop Ventures, and he was pointing out that the component shortage is really going to be the biggest challenge. How is Tesla placed here to address the supply chain shortages?
Yeah, they've been faring better than others in the auto industry. They are a technology company, and they write their own software. And so they've been modifying the software so they can maximize those precious chips, and that's how they're able to sell almost 250,000 vehicles in the third quarter. So while it has slowed them down, and they say it's preventing them from running their factories at full tilt, they are still doing better than the legacy automakers in that regard.